All right, here's an episode for all the math and physics nerds out there, and I'd like to give an uplifting message to anyone that is into modeling and theory like I am. If you see a bunch of patterns that work together, do not be afraid to reach out and grab them. Reach for your dreams, people. Reach for your dreams. This is Brian Lewis with MMT Investing, and things just changed. And please hit the like button if you want me to keep posting content. Okay, so, and this is not financial advice. Okay, so, um, yeah, let me just kind of explain the general idea with the mathematics on this thing. Basically, we have a big pattern, which is the financial system expansion contraction versus the growth or losses in the business sector is the main line here. So like this downtrend line basically gives us our tangent on that curve. And this is a second derivative line if you like calculus. So it's not like the growth uh, and the expansion or contraction of money, like the amount of loans available or the amount of loans not available. This is a second derivative line. So it's the change in the change of the amount of loans that are available. So the point where you start doesn't matter. It's just if the change in the amount of loans goes down or up, and then it's not the level where the business growth is. It's whether or not the business growth goes up from where it is or down from where it is. So it's a second derivative line. This roughly gives you tangent of that line. So like these aren't like straight line points. Plus there's weekends in here. Like the financial system curves don't take a break on the weekend. So anytime you draw a straight line, like it's not a real line. Like these things, I mean, they sweep, well, I wouldn't sweep there, but like these things sweep and they reverse, you know. But we're just getting the rough like sort of tangent line on these sweeps, and that really awesomely affects the trading. So like this trend line is a macroeconomics trend line that has to do with the financial system and the business sector. But like all of these cool little things, this is people. This is people's reaction to that line. So I guess let me put it like this. Like say you're skiing behind say you're skiing behind a speedboat, right? This is your speedboat. Okay? Like where well that's not the bottom of it. But anyways, just for example, um say you're skiing behind a speedboat, okay? Like you're going where that speedboat takes you. You don't have a choice in that. It doesn't matter how people feel about stuff or what the news says. Like you're going where that speedboat's taking you, but you have the freedom to do whatever you kind of want behind the speedboat, right? So these lines are people skiing along the speedboat line. Okay, so like here, okay, let's look at a couple patterns. So like you get on this leg down, right? You get like a little swoop, right? It's like an S curve on the way down. And this is a really common shape, and sometimes it happens at critical like resistance levels like this, and that's really cool, and that happens. Um, and then like here's like a little swoop on the way up, right? And that's what people do. They do a swoop. Okay, and then like this here, like this is not a technical analysis channel. This is a macroeconomics modeling experiment. It's macroeconomics. This is not technical analysis. But I do like to put the technical analysis points in here. And a lot of these points, I see other technical analysis people drawing lines, and I'm like, oh yeah, that's really cool. So like this 2008 super bull trend line, I saw this on a channel called Game of Trades. And that guy is so good at technical analysis. Like, he's just awesome. Like, I follow his channel and he's killer. And this is not exactly his line, but like he gave me the idea for this line, and then I went back in and worked on it. And this is so cool. This is the line that made me want to make a YouTube channel right here. As when we started back testing this line, I was like, wow, all right, this is really cool. I mean, and then this line, and then I saw like this line is a back test of this thing. Like, that's technical analysis stuff that I don't do. But like after it happens, I'm like, wow, that is right on it. It's really cool. But anyways, um, that's the general idea, right? You get your speedboat line from the second derivative of inflation versus growth. If you watch Hedgeye, like they use this model and I love their data. They have incredible data. And this is not an advertisement for any of these people. I have no affiliation, but like the inflation versus growth data uh, is amazingly useful for trying to predict these lines. And those guys talk in 3-month cycles, and they don't get into any of this stuff, and they're wrong a whole lot on the short-term moves. But their like 1 and 3-month kind of cycle data is absolutely awesome. So so let's talk about swoops. So this little guy here, like if you talk to a technical analysis person, they'll tell you that this is like a descending downward dog 720 backflip consolidation wedge reversal or something. Okay, I call it a swoop. It's a swoop. That's what people do. They swoop. So this is a bull run swoop. This is a credit contraction swoop. This is a bull run swoop. And the exact mathematics every time on these swoops is that usually the little swoopy thing comes, usually it's like a little bit before halfway. Um, so, so yeah, like, I mean, yes, it does make this kind of wedgie pattern. But that's just because this is a wave. Like, and that's when you draw a triangle around it, that's what it looks like. But it's just a wave swooping. Yeah, okay, so that's the general idea of the sort of the math and the swoopiness. But if you follow the patterns, oh man, I don't have enough internet to get back to one. Well, whatever. Here's one. Oh, okay, let's look at this one again. So like this is like, well, I think this one's a little longer than 3 months, but this is a pretty good credit drawdown cycle to look at. So you get like the drawdown, bounce, bounce. It's like a 3-month thing, just what we're looking for here. Drawdown, bounce, bounce, a 3-month credit cycle. Except this is a bull market credit cycle where it's squeezed down by the upward movement, and this is a bear market credit cycle where it's like squeezed up. It's bigger because you're on a downward. So just comparing this one to this one tells me that we are in a bear market, a long-term bear market, and then if you look at the swoopy swoops here, it does the same stuff, right? So here's a credit drawdown, and you get swoop about halfway, right? And then you go up and you get a swoop up to the bull trap, and then you go down and you swoop back down, and then you go swoop up to the next bull trap, and then you go swoop, and then this leg here is the hard one to predict because this second one, a lot of the times the second one bounces sideways. I mean, it could be like a little bit off of sideways somewhere. Sometimes it bounces. Actually, sometimes the middle one will be pretty hard to tell too, but these ones are on average sideways. So sideways is an easy guess on the second bounce. The third bounce is absolutely crazy. Like depending on how growth factors into this third one, I mean these can be absolutely anywhere. So I mean your bull trap can run up like this and you can bounce here. And it's just a massive like run up. Or you can do this and you can just turn over and just dive. So the third bounce is really, really hard to predict. But it follows the same pattern, and it's not, I'm drawing the speedboat line, but the line is gonna be a swoop. It swoops. or swoops like this one. So that's it. So I'm just looking for speedboats and swoops, guys. That's really it. And then this drawdown gives you a rough idea of the cycle. So, I mean, I just know that we are in a credit contraction and down growth right now. So I'm just predicting that pattern. And this is an easy pattern. There's two patterns that are easy. There's the growth up and money up pattern. It's the up pattern. It's just like up. It's easy. It's just straight up. That's the easiest pattern. And then this pattern is growth down and money down. And that pattern is more complicated looking, but it's still pretty reliable. It's just like 1, 2, 3. Um, it doesn't always work out to 3 months. Like these could be 2 months, it can be 4 months ish, but it usually is around 3 months. I don't know why it's around 3 months, but it is. And it's probably just because like credit and bills and payments and stuff are due monthly, and then there's just quarterly changes in the financial system and the financial news. I mean, it kind of makes sense that it's like 1 month, 3 month kind of intervals. But anyways, that's what it does usually, and I just use like so like when you get this, when you get the growth and the inflation sort of information for the contractions and stuff like that, like you get a really fuzzy picture maybe 6 months out, and then you get a very clear picture once it's like 6 months in the rear view mirror. So like right now today, like we have a pretty fuzzy idea of all that data. It's not like you have like a monstrous pile of exact numbers to draw some like math equation with. Like you have an absolute mess of guesses on the data that you try to just get a rough picture with, So um, anyways, that's the general idea. I hope that anyone that likes math and stuff, uh, doesn't isn't afraid to use it. Like this is a cool like kind of math and physics and modeling kind of experiment, and it involves psychology, which I think is really cool. This is like a math and psychology, math versus math versus psychology like graph or something. It's pretty cool. Um, so anyways, that's what I'm looking at. I'll be surprised if this doesn't happen, and I'll have to figure out what's going on. But this is pretty cool, and this is what I see coming, just for like the next, you know, uh, month and a half. Once, and then this point is, I mean, I just threw it on this line just 'cause whatever. Like that's an obvious spot to just kind of throw it. But um, once we get to this point, like that is when all of the fundamentals switch, and we're gonna go into positive growth and positive money available. Right here, it's gonna switch. So the fundamentals of absolutely everything that I'm doing right here flip, like literally flip upside down. And we end up doing a growth phase in a bear market, which there's like well, this is all bull market, so like there's no good examples of what it's going to do. I'll get to that later, whatever. Anyways, here's some swoops, here's some speedboats and some swoops, and then I get in more aggressively into the swoopiness here on my last video. I got into this, and I tried to predict the swoop a little bit more aggressively just based on some lines that we had to use. So I just did the swoop here, and then I did the swoop, but I just bounced off these lines that we have, which, I don't know. Probably like after you get the actual swoops, like you could just draw another line and then be like, oh, that's the line, but whatever. I mean, we have a pretty good line here to guess with, and that's what I'm looking at over the next week. Cheers, happy trading.